Donc, bonjour tout le monde. Bienvenue à ce webinaire that talks about the acquisition of distressed businesses and untapped opportunities with a twist in perspective, which is the French perspective and the GCC perspective. We have three entities with us: Eptelex Law Firm, representing GCC and as a global law firm, Herald as well, based in France, and O3 Partners. So now we're leaving the floor for Rami to present our two speakers.
Great. So thank you, Pierre-Yves, Isabelle, Myriam, Nael, for those insightful presentations. The French segment has shown us where the opportunities lies, how distressed acquisitions are structured, and how the legal framework can facilitate successful transactions. The next question is equally important. What does a distressed acquisition look like from the investor's side? How do experienced investors identify opportunities? What differentiates a business that can be turned around from one that cannot? What warning signs should buyers look for? And what lessons can be learned from some of the largest restructurings and corporate transformations in the GCC? To help us answer these questions, we are joined by two exceptional practitioners whose combined experience spans restructuring advisory, investing board governance, insolvency, turnaround management, and corporate leadership. First, Abdul Wahab Al-Halabi, very good friend. Abdul Wahab is one of the Middle East leading restructuring, turnaround, and investment professionals, with nearly 3 decades of experience advising, investing in, and transforming businesses across multiple sectors and jurisdictions. Abdul Wahab began his career in corporate recovery at KPMG, where he spent almost 10 years working on insolvency, debt structurings, and large-scale turnaround assignments before becoming partner and co-leading KPMG's restructuring and debt advisory practice in the UAE. He subsequently held a series of senior executive positions, including CEO of Dubai Properties, Chief Operating Officer and Group Chief Investment Officer at Meras, where he led the financial turnaround of the group, established new governance structures, and oversaw asset management, special investments, and overseas portfolio. Today, Abdul Wahab serves as Executive Chairman of IFCO Group, Managing Director of Embassy Capital, Senior Advisor to Holy Loki in the Middle East, Board Member of Abu Dhabi Islamic Bank, Board Member of Talabat, of Bujil Holdings, JBF Energy, and Al Masar Education, among others. He has also served as Vice Chairman of Union Properties, Chairman of Dubai Parks and Resorts, CEO of Global Investment House, and Board Member of NMC Healthcare during its administration process. What makes Abdul Wahab uniquely qualified for today's discussion is that he has seen distressed situations from almost every angle, as a restructuring advisor, as an investor, as a lender, as a board director, chief executive, and turnaround specialist directly responsible for restoring value in complex situations. Abdul Wahab is also an Ironman competitive athlete, and he just landed in Dubai this morning following a training camp in Italy. So very grateful he made it for the webinar. Joining Abdul Wahab is also Antoine Abirashid, who is the region's most experienced, I would say, corporate legal and governance executives, with more than 30 years spent advising boards, management teams, lenders, shareholders through some of the most significant corporate events in the GCC. Throughout his career, Antoine has held senior legal leadership positions with Dubai Holding, Abdul Latif Jameel International, Al Ustamani Group, and Dubai Investments. Most notably for today's discussion, Antoine served as Group General Counsel and Board Secretary of Arab Tech during its historic liquidation, and as Group General Counsel of Drake & Skull International during one of the UAE's most significant restructuring exercises. Unlike most advisors who observe distress from the outside, Antoine has lived through this situation from inside the boardroom, helping companies navigate financial pressure, stakeholder negotiations, governance challenges, and transformational change. Together, Abdul Wahab and Antoine bring the perspective of the investor, the lender, the board member, the chief executive, and the general counsel. Gentlemen, thank you both for joining us today. I will address both of you simultaneously, if that's fine with you, and look forward to reflecting on both your experiences. So to start with Abdul Wahab. Abdul Wahab, after nearly 30 years working in restructuring, debt advisory, investments, and turnarounds, what would you say is the first thing you look for when assessing whether a distressed company represents an opportunity or a trap?
Thanks a lot, and thanks for the very long introduction. I feel like I've been around the block more often than you've made me see. From my perspective, I've operated in Europe where I've listened to the last half an hour to talk about France. I continue to currently operate in some distress situations in the UK and in Belgium at this moment in time. And obviously across the Middle East extensively in the last 2 years. I think the primary driver of, or the first thing we would look at as investors coming into a situation is control, number one. To what extent can an investor control the situation that they're in? If they're coming in as an investor via debt instrument, to what extent they can have security, share pledges, charges, mechanisms that ensures that they actually have power over the entity beyond the current stakeholders who are often the equity holders and lenders as a fresh investor. That's number one. Second, that you would look at, and if that doesn't work, there's no point looking at the business at all. You can't come in and there's no point discussing what business about. Second item that kind of comes up very quickly is what hidden value is there? And often in these larger situations, there's the sum of parts is greater than the value of the whole circumstance, or the larger situations. In the smaller situations, it's more of, has a cycle hit the business, or has other events, external events or internal events hit the business that made it underperform? Many situations, like some of the ones you've named, some are public. For example, Union Properties was a fraud. It's public that it was a fraud. We know that it's an external event that's created a destruction in value. So for me, there's an obvious arbitrage there. When you remove the fraud event, then you can realize the underlying value. And sometimes it's cyclical. You just got the wrong cycle. Sometimes it's many other events. But if you understand there's an external event that created the mismatch from market price, we're interested, because then we see an arbitrage situation if we do the right work. So these are the two maybe key areas. I can spend many hours talking about them. These are the two big spots that we would look at in the beginning before talking about governance and changes and involvement.
Very insightful. Thank you. Thank you, Abdul Antoine, from your experience inside some of the region's largest restructurings, what would you say are the warning signs that are usually visible long before the market recognizes that a company is in distress?
Yes, thank you, Rami, also for the introduction, and special hello to Abdul Wahab. We did come across each other in one of the also large restructuring exercises that is not mentioned here, and prior to even the existence of a bankruptcy law. So where we were feeding basically the legal profession and the judges, what is the school of thought behind this approach? So Salam, Abdul Wahab, inshallah we reconnect again. Thank you, Rami, for the question. Yes, obviously, failures and bankruptcies start way before it actually starts. In my experience, and I'm addressing this forum obviously not as a lawyer, but as a hands-on operator, where I did manage when other C-level executives have departed their positions in the companies you have named, where we have managed to carry on and be in the trenches and be with the people on the ground. So I think the initial one is belief. When your banks stop believing in you, when your employees stop believing in you, and when your stakeholders stop believing in you, this is where your bankruptcy starts. Everybody wants their cash on hand. Banks heighten the rates and require immediate payments. Your employees, the good ones, start departing. You are left with the hibernators. These are the early warning signs, obviously, and specifically in the industries you mentioned, which is construction. fresh cash fuels existing projects, which is also a very big warning sign. You get wrongly priced project to fade and to keep your cash flow going. This is also a very early sign of a distressed project. Most people and most big companies in this environment have big backers, so they tend to delay obviously that the final step, because they will always rely that one of the big backers will come in and put in the money, maybe for commercial reasons, maybe for reputational reasons. So you need to really look very, very closely at companies here before acquisition. But the early signs are always obvious.
Great, thank you, Antoine. Moving on to creating value. Abdul Wahab, we have a beautiful success story of the turnaround of Union Properties. If you can just briefly talk about it and maybe enlighten us on where is the value actually created in a turnaround situation.
Thank you. So the good thing about our industry in restructuring is that actually it doesn't need a lot of brains. It's not rocket science. Often the mistakes are so large or so big that just doing the ABC of running a business can create value, just being just common sense, really. In the case of Union Properties, which is a listed entity, so we can talk about it fairly openly here, it was a simple situation of catching the cycle. The situation happened in 2020 and 2021, where the fraud was uncovered and we took over the business. We were investors in that situation. I personally was as well, along with quite a few others. And there, it was simply about understanding that the real estate cycle was picking up. So number one, governance, once you're inside the business. So we talked earlier about what we look at when we come in, but now that we're in, the first thing you do is governance. And governance is just ABC, boards, committees, SOPs, standard governance that you would see in any company. It's almost off the shelf. And then you modify it as you go along, particularly if you don't have multi-jurisdictions. For multi-jurisdictions, it's another story, but in UP's case, we were largely UAE-based, where it was very straightforward. And so number one. Number two is getting the right people. To Antoine's point, your good people leave, and good people outside don't want to be there. So you need to understand the balance between hiring people that A, you can afford, you don't have much money. So you tend to be not able to pay for the premium talent. And B, they don't want to. So you pay for maybe slightly less talented people, but within the right structure and the right governance structure. So even if the person maybe not quite up to scratch, the governance helps them, and the institutional setup helps them. They then kind of drive their way a little bit forward. You then have to be very wise and understand that 2 or 3 years in, that person is no longer fit for the job. Because by then you're out of the woodworks, you're a more successful company, you're more attractive to better talent. You need to learn how to exit people as well, and to bring in the correct talent for the job. I know that this is an anomaly in some other jurisdictions, particularly in Europe, where this notion of churning people is less attractive to the setups over there. But I see this as very, very critical. Having the correct talent at the right time and being able to churn it to the correct talent for that moment in time afterwards. Institutions. So to summarize, governance, institutional setup, and talent. And then afterwards, it's whatever the underlying business is. I hope that helps.
Fantastic. Thank you, Abdullah. So government, institutional, and people. Antoine, what are the, based on Abdul Wahab's intervention, what are for you the, let's say, the governance and management factors that most often determine whether that value is ultimately realized, according to your experience?
Yes, obviously, I think where the errors start is by errors of management, and specifically, and again, I stress on the difference between this market and other markets, the too big to fail concept. When you are massive, when you are dealing with billions, when your backers are major investors or major companies, you get that false sense of security. I mean, obviously, people lie, numbers don't lie. You reach a point where the numbers will catch up. The reality is there. So governance is obviously key. There is a lot also in this market of what I personally call the political projects, the projects that you know are potentially at a loss, but you have to take because of some particular, business-like influence or some particular nepotism influence. You find yourself in also situations where, in proper governance structures, those will not even happen. And one more word of thanks also to Abdul Wahab. We are major also shareholders in the Union Property, and thank you for the job you keep doing there, and for saving us a lot of money. Obviously, Rami, you spoke about value. Value is not really only about making the money, but in my experience, it's mostly about saving the money. So if your bottom hole is 10 billion and you come out with one, to me this is more saving than any potential IRR on any business anywhere.
If I can ask both of you to answer this, would if you had a choice between, let's say, outstanding assets but weak management, or an average set of assets with an exceptional management team, what would each of you choose? Abdul Wahab?
This is a bit contrarian, but I always go for the assets. People, unfortunately, in the world that we live in the way IT has driven productivity, mobility, and indeed AI sometimes replace it, unfortunately, talent has now taken a bit of a second footing to good assets. We always chase nice assets.
Okay, talent is commoditized, let's say.
Unfortunately, of course, this is a very broad generalization, but in general, we chase assets.
Okay, Antoine, are you of the same opinion?
Yes, obviously the asset, it doesn't have to be a magnificent asset. It has to be in a business that is not either obsolete or, fell behind its time. It needs to have, let's say, the right IP, the right client base. Obviously, this is your start. But then, obviously, as well, a magnificent asset with a bad driver is like a Ferrari giving it to a 4-year-old. So really, it's a combo of both. And the timing of the asset that you cannot time, what you can time is, injecting the right people in that asset.
Thank you. Abdul Wahab, let's move to more of the investor side of things. If, let's say today, a GCC family office was considering its first distressed acquisition in Europe, and I know that you have, over and above the GCC experience, you have a more of a global experience. And what would be your advice, let's say, to this family office to focus on before committing capital? What should they look for?
Yeah, brilliant question, and I think very topical for the audience. I've listened into some of the earlier conversations, particularly about France. There are a number of things that come to mind first. I'll talk about the nuance and not the broad stuff, because I think everyone here is a practitioner, so I won't go through the basic stuff that we all look at. But the nuance that's important is what's happening in terms of latest on labor laws. Everybody knows Europe is very difficult. It's not rocket science. We all understand how that works. But there are nuances that change over the years and that make one country way more attractive than the other. We're currently exposed in, I mentioned Belgium, we're exposed in Germany, Spain, and the UK, but largely Belgium and the UK. And you've seen over the last few years that that's changed. We're not exposed in France for exactly that reason. We find it very, very difficult to handle the labor situation. The second aspect we look at very quickly is we're getting money in from the outside. You guys are saying foreign investors, that's wonderful. Try getting your money out of here. In particular, try getting your money out of France. So you've got ATAD 1, ATAD 2, ATAD 3, you've got GCC 6 now on tax that are impacting all of us quite significantly. And the rules are a little bit differently applied in different jurisdictions. They might all have European rules, but try arguing a case in Paris court compared to a court in Berlin. We've had both of those experiences. So tax is a massive issue, trying to get the money out. Number one, stickiness of the money, because sometimes the labor situation and labor regulations in certain jurisdictions can drag you out. Germany less so, Spain maybe next, France is pretty poor. Belgium is much more poor. UK is very easy. It's almost America. The third thing is what's happening in terms of liquidity and the depth of the market. So when you're coming in, cheap assets are cheap asset. You're always going to make money. That's great. It's just how much. Now, if there's no liquid market in that environment, so you struggle. So if you're in southern Spain, you struggle. Belgium, where we are, we struggle. Netherlands, not so great. France is very liquid and very deep. Germany is very liquid and very deep. UK is very liquid and very deep. So we like those markets because we can get out as someone to buy something at the price. So that's another situation. The third thing that we find, or the fourth thing rather, that we find, which is very detailed again, but very difficult and very complex, is that the liability on the buyer. As UBOs, as directors, as shareholders, we are now at a much higher risk and culpability as managers and leaders of companies than we were 10 years ago across Europe. This is not it's not singling out one country or the other, whether it's in the EU or out of the EU or here or other countries. And that makes it much more difficult to navigate the situation. You become much slower. So when we operate in Asia, it's very quick. We're in and we're out and we know what we're doing. The rules are fairly set. In Europe, you could make a misstep and suddenly you're criminally liable as a director. Was something you didn't really realize. You end up needing a lot more legal support, a lot more backup as every time you take an action, and that slows things down. So these are the 4 or 5 things that we look at when we're investing in Europe.
Thank you, Abdul. Music to our ears, lawyers and tax consultants, in structuring these kinds of acquisitions. Antoine, from your side, anything specific that you would be looking at in distressed, let's say, investment opportunities in France, and also maybe any sectors that are basically interesting in terms of, let's say, for instance, would you go for real estate, construction, healthcare, technology, energy? Where are you seeing the trends today?
My investment has more than 40 lines of businesses, spanning from owning hospitals to pharmaceutical production companies to real estate, education, universities, schools, facility management, you name it. We are across the board, and we are also geographically agnostic. We will follow the opportunities. We have interest in many sides of the globe. So yes, obviously, but again, we go back to the fundamentals. When we are looking at a distressed asset, obviously we want to see some sort of evaluation arbitrage. We want to see like we are acquiring a hard asset of a business that is still somehow alive, or an intellectual property, specialized licenses, equipment, and very importantly, from my seat as a lawyer, also active commercial claims. Where we can, pursue and buy these claims at a lower value. So this is my first, if I can call it, pillar. The second pillar is for the legal system to facilitate a clean slate type of necessity. So a judicial system and judges that are willing and able to approve restructuring and scrap off legacy liabilities. For example, France, and with my limited experience, but based on my education, it's a very employee-friendly, harder for the companies. You tend to think twice before entering jurisdictions of that nature, that they don't facilitate wiping off, and I will stand corrected with any additional comment from the lawyers on the call. And the third pillar is we have to look at government, specifically when you're looking to invest away from home. Home is an environment that we understand, we control, we know the people, we have the connections. When we are looking at something away from home, we need that leadership premium. We've seen businesses fail really not because of the engineers on the site, right? It is really because of the top of that pyramid that has not done things like they should do, or up to their limitations. So we need to find the right governance, inject operational discipline, really to unlock the alpha that was trapped underneath. So to your question, yes, we are very open, but we need these pillars to be there.
Fantastic. Thank you, Antoine. Gentlemen, thank you very much to both of you. I believe one of the key takeaways from this conversation that distressed investing is rarely about just buying cheap assets. It's about understanding risk, identifying value, and of course having the right governance, management capabilities, legal support, and a credible plan for transformation. With that, we will now move to the next section of our program, where the EPTELEX team will be discussing how these acquisitions can be structured efficiently from a GCC perspective. And we're moving to Bashir.
Thank you very much, Rami. Thank you, ladies and gentlemen. I'd like to start with one of the largest distressed assets that has in the past hit Dubai. And I go back to what has happened with the 14 billion private equity Abraj. At that time, it did collapse on the forensic that was appointed by the Bill and Melinda Gates Foundation. But since then, Dubai rebounded, DIFC rebounded with a 2021 triggering a 58% explosion in asset under management, up to, if I'm not mistaken, 700 billions, with the largest asset managers being in the UAE. And ADGM, which is the equivalent of DIFC in Abu Dhabi, has a similar track record to boast. So distressed is not something that the UAE is scared of, nor distressed assets at all, because we've seen the biggest out of it. However, the lesson that has been learned in the UAE is that the UAE has upgraded itself and lifted itself to a certain governance and discipline that made it the platform of choice. You're close to capital. You have two common law-driven systems, being DIFC and ADGM, Abu Dhabi Global Market. Your proximity to capital does not necessarily mean you're compromising on transparency. You're able to structure any investment the way you want, be it in DIFC or ADGM, you name it, all classes of shares, all classes of corporate structures, all classes of debt, serving the appetite of equity investors as much as serving the appetite of debt investors. So broadly speaking, I think the UAE, with its common law-driven centers like Dubai International Financial Centers and the Abu Dhabi Global Market, sits at the forefront and as what I would call platform of apex investors. How does this fit into distressed assets in France? It does pretty much, because as Antoine and Abdul Wahab said, UAE investors are very agnostic, and they look at the opportunity with a very, very shrewd and objective eye. They look at the assets, but they also look at the entire background of it. Elements such as employment laws and creditors, bankruptcy rules are very much the crux of the game. Now, again, back to the basics, back to what we call the platforms of investors. You are able to structure any investment vehicle in the UAE. Make sure that if you have lenders, they are very, very comfortable with your governance, given that they have visibility. Most importantly, you can afford them the recourse they are very comfortable with when it comes to France, the UK, or the US. So lender-friendly, investor-friendly, but at the same time, it is a platform that allows you to exit at a very value accretive point. So you're capable of building your business, making sure you are in tax neutral jurisdiction, and at the same time, you're able to monetize your valuation. So this does not necessarily mean that you're going to be in a situation akin to your typical offshore jurisdiction, not at all. I think that governance is paramount to every credible structure in the UAE. I think what I could say is the outcome of this entire setup is that governance and discipline have met an optimal balance with flexibility, where you are affording capital the appetite that it needs without compromising on the safety nets that the public policy requires you in order to maintain long-term viable investment. So just going back to a bit of the what I would say traditional structuring, you are capable of creating a holdco or an SPV in ADGM and DIFC in a couple of days, provided you have all your ducks in a row. Let me just be more reasonable. It takes probably a week or two to create a holding entity. But by world standards, this is pretty much track record. You're capable to structure your governance likewise in a very robust way and be able to set the exit to your investors, provided you have coordinated between the asset base and the investor base. And where both have visibility, you are capable to succeed in the investment structuring. Thank you.
I'll just add a few words on what Bashir has said, which was a good summary of how structuring can be used in the UAE. Just a few points. So he mentioned the DIFC and the ADGM. These are the preferred, let's say, free zones for such investments for a simple reason. They are common law jurisdictions, which distinguishes them from the other free zones or from mainland companies in the UAE. So these free zones work entirely in English and have their own court system and are based on common law to a different extent. But they are common law jurisdictions, which make them more familiar to international to the international investors. Also, Bashir has mentioned the special purpose vehicles, which are passive holdings. These are some of the structures that are available that are very light, without substance, let's say. But there are also other alternatives. There's also holding companies, proper holdings that can be used if there's a need to have substance from a tax perspective. So in case there are management fees, for example, or the need for employees at the UAE level, it can be more, obviously more structured in a sense that it could be a fund, a proper fund that is where investors are channeled. They can be professional investors or not. And it can be an investment company, an LP, GP structure. And we also have structures such as variable capital companies in the DIFC and similar structure in the ADGM. These are companies that have a variable capital that will vary the capital based on their assets. But also the interesting thing is that it would be this company is split into multiple cells, and each cell has its own assets and liabilities, which is distinct from the rest. And this is often to be used in investments, and it is used mostly by family offices, but not only, to invest, whether it is in the UAE or in Europe. So this is it. Thank you.
Okay, thank you, Carl. I think now we move to the conclusion with Baki and then Q&A.
Thank you very much. Thank you very much. Thank you, Rami. I would like to be quite brief since we have a little bit of time now. I just would like to thank all the speakers and the participants. And I would like to leave you with 3 key messages. First, as we understood, distressed businesses should not be seen as failed businesses. It's quite often the opposite. They are companies with valuable assets, strong brands, skilled employees, established clients, and significant know-how. What they lack is not necessarily potential, but capital, restructuring expertise, or a new strategic vision. So that's, for me, maybe the most important point. Secondly, we saw that with our friends of Herald and O3 Partners, and with our experts in the GCC, in Eptalex, we can be of great help to address those questions in courts and out of the courts in order to help acquisition and investment in France or the UAE and the GCC. I'm not going to be long, so I just wanted to basically highlight these few points. It's very important for investors who are prepared, well advised, and willing to take a long-term view. I really insist that France offers exceptional opportunities, and of course, we would be delighted to assist you in exploring them. Thank you very much. And I think we have a few minutes left for a Q&A, so we are all at your disposal.
We had questions that were asked, and thank you, Isabelle, thank you, Nael, for responding to them on the chat. But we are open for anybody who has any questions, whether to our speakers or regarding the content. I think all the questions were covered in the chat. Let me make sure. Yes. Any further questions from our 40-something participants? Okay, this will make us conclude this very interesting webinar. I think we are all quite interested to see that there is opportunity in distress situation. I thank you all for participating. I thank the Eptalex, Herald, and O3 partners to be part of such an interesting panel and webinar. And I hope we'll make this a recurrent thing. Thank you very much all, and have a nice day.